Hello. What you're about to see is rated R18. Parental guidance is recommended. Some viewers may even find it disturbing. Please don't try this at home.
What if I told you there was a way to buy things like this $100,000 watch without spending a single dollar of your own money, using business credit like this that you never actually had to pay back? How I got this watch, I was able to open a business that I didn't really give a shit about. I went and opened business credit cards in that account. I then proceeded to go on, buy this for $100,000. I'm gonna turn around and sell it to a jeweler for $80,000 in cash, which now gives me the cash. I'll file bankruptcy on the company. I'll never have to actually pay it back because I'm not personally liable for that American Express card. It's all liable underneath my business.
Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. Guys, if you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and there's no two ways around it. It was a very green day. Investors buying the dip, loading up on shares ahead of the FOMC. The only real red sectors we saw was the smaller names here in semiconductors and semiconductor equipment manufacturers, as well as, some of the larger bank names. That's about it. Other than that, it was a very bullish day across the board. Comm services, the best performing sector, real estate, the worst performing sector, but still gains across the board in large caps, mid caps, and small caps. Growth outperformed, but regardless of where you were positioned today, you did very, very well, and you've done very, very well this week. And all of this stemmed from stronger than expected economic data that we got today. Initial jobless claims came in at 230,000, pretty much in line. Now I know the forecast is 225, but I had some firms out there saying 228, 229 was their forecast, both for Goldman to be specific. So initial jobless claims came in line. Producer price index, things were a bit shaky, but nothing crazy after yesterday's CPI. For those of you that don't know, PPI is the inflation businesses pay. CPI is what you and me paid, consumers. And you can see the producer price index month over month, the headline came in line. The core came in a little bit harder than expected, but looking at the year-over-year figures, things continued on the disinflationary path. 1.7% versus 1.8% forecast, and the same is true here for the core figure, 2.4% versus 2.5%. So pretty much regardless of this figure, like the CPI figure yesterday, things are on the disinflationary path. Things are moving lower, inflation is moving lower, and that really did boost stocks today. Another thing that did help stocks was Jensen Huang at Goldman Sachs Tech Conference came out and said a couple of things with regards to Blackwell. There was some rumors circulating that Blackwell was going to be delayed into the first quarter of 2025. He came out and pretty much dispelled those rumors, saying, hey, we're good for a Q4 ramp in 2024 and then major service delivery to happen in the first quarter of 2025. He also came out and said that there's a ton of CPU compute that needs to be changed over to GPU compute in data centers, not just for AI, but for broad-based data centers. And he said that that could be valued at about $1 trillion over the next 5 to 10 years. So this is just money in Nvidia's pocket, not just from the hyperscalers, but from everybody else. And that's really what boosted tech today. That's really what boosted the market today, but also the rate cut fever as well as the economic data. The best performing indices was the IWM up 1.28%, but the Nasdaq 100 was up a full percentage point as well. The S&P 500 and the RSP didn't gain as much, but gains nonetheless, and you take those gains when they come. Globally, we also had a very upbeat day, green across the board. It was really only South America that felt a little bit of pain, but green in most of the other geographies, green across the board. Very, very green here, guys. And a bullish day heading into FOMC rate cuts. And actually, it's not just the Fed that's looking to cut rates next week. There's a number of European countries that are looking to do the same over the next couple of weeks. Same here with Australia. Rate cuts are certainly on the table, and I believe we should probably see the same with a lot of these Asian countries as well. So we're on the verge of a global cutting cycle. That means cheaper capital, and cheaper capital simply means liquidity. This is going to unlock certain things in the economy, the housing market, the LBO, the IPO market. All of these are really going to provide liquidity, earnings, and breadth to the market into 2024-25. And that is why we're seeing the action right now. Investors are taking advantage of that, buying the dip, because cutting cycles with strong growth leads to outsized returns. And guys, looking at the charts, we saw some very interesting developments, but nothing out of the ordinary. Yields actually rose on the back of stronger economic data. bonds fell, the dollar also fell. That did support the overall price action in the equity markets. Very interesting to see that the IWM rose on the back of yields rising the last couple of days. That probably goes to show the buying power underneath the hood with regards to rate cuts coming next week, or the FOMC I should say. And then silver up 4%, gold up 1.94%, and Bitcoin up 1.48%. So commodities really rallying ahead of these rate cuts. Look at gold, another all-time high, 25.60, and then silver at the $29 level. This is looking like a really good base right now for silver to go ahead and take off. This to me looks like some form of an accumulation ready to like rip up when the Fed starts cutting rates. But looking at the S&P 500, the very first thing you could see is look at this advanced decline line. That's an all-time high in the advanced decline line in the S&P 500, in the Nasdaq 100, the IWM as well. So advanced decline line making new all-time highs as indices are not at their 52-week highs or all-time highs. That's very, very bullish. Also here with the RSP, same thing. Advanced decline line, new all-time highs. Very, very constructive, very, very positive. If we actually also pull up something like the relative strength index, the markets are not overbought just yet as well, despite the momentum we've seen in the last couple of days. In fact, markets are rather neutral in the RSP, the S&P 500, the Nasdaq 100, as well as the IWM. But things are moving in the right direction. Zooming in, you know, the low we put in right here is really starting to look like a higher low, especially as these highs come into focus. All the double top bears are in shambles right now after this low right here. And that's why you never ever look at chart patterns, support and resistance, technicals, the macro, the fundamental. That is what drives price, not chart patterns. Chart patterns are complete bogus, guys. Don't pay attention to it at all. What we did see is simply a higher low, buyers stepping in at the put support. The put support moved up today. The gamma flip stayed where it is and the core resistance moved up, showing the intention that buyers want to get long into FOMC. They're rolling their strikes out and higher because of rate cuts. And I think we're going to go test these highs. Maybe not the end of this week, but possibly the start of next week. I definitely think we're going to go ahead and test those highs and see what comes next. These highs pretty much open up all-time highs. Things looking largely constructive for the S&P 500. We're in positive gamma, so you buy dips, sell rips, and as long as we stay above this 55.50, any pullbacks we do get here should just be viewed as buying opportunities for us to go ahead and rally up to these highs right here and the 56.75 area. And I do think that this is going to keep moving up if we keep getting candles like this. It's our fourth green day in a row in the S&P 500. Very bullish action. Things look super pessimistic right here, but I kept saying buy the dip. We're going to go higher. September can be volatile. It's historically normal. And look at where we are right now. It does appear we have front loaded a lot of September seasonality, but I'm not here to say we're out of the woods just yet. All of this buying action could come crashing down because that's just the nature of markets. September, October, and there's an election. That is the biggest volatile event. And to be honest, after that most recent debate, it's a coin flip who wins this election right now, in my personal opinion. Very similar chart to the Nasdaq in positive gamma. The gamma flip hasn't moved and it's looking to go ahead and take these highs, and that's what bulls need to do. This looking like a higher low in the context of this low right here. A very similar thing to the S&P 500, except not all-time highs, new 52-week highs, but I would love to see more strength come in the IWM over the next couple of days into the end of the week. We can actually see that here in the after hours, though. It was the best performing asset today and flat in the after hours when the majors are slightly down, but inconsequential in my opinion. And then looking at the RSP, very similar situation. We said the 171 is the area to hold. The bulls did hold that level, and now we just got to go tackle these all-time highs. Still looking very, very strong. But I think after, this move right here, I think we just got to have a bit of a digestion period in the RSP and maybe a bit of a rally here in the Nasdaq 100 and the market cap weighted indices. All in all, I think things look constructive to go higher as long as we stay in positive gamma across all of these indices. So looking at sentiment, this is the AAII sentiment survey. A question that's asked to these members: what direction do you feel the stock market will be in the next 6 months? And AAII members are feeling a bit more cautious on the market after being very optimistic in the last couple of weeks. We saw sentiment in the 50s. Normally when it gets here, we actually do see a sharp rebound. That's exactly what we saw. Bullish sentiment dropped from its recent peak, and bearish sentiment has ticked up as well. Neutral sentiment remained largely steady. This suggests growing uncertainty about the market's direction in coming weeks, especially heading into the FOMC FOMC next week. However, both as private clients continue to be net buyers, we saw single stock driven inflows. Single stocks were bought more than ETFs last week, during which the S&P 500 was negative 4.2%, the worst week since March. Both as clients were net buyers of US equities. Clients bought single stocks and sold ETFs, with inflows solely into large caps. Retail and hedge fund clients were net buyers too, after selling equities the last 2 and 4 weeks respectively, while institutional clients were net sellers for the third week in a row. So a lot of the selling we're seeing had to do with institutional clients. Interesting. These guys are like pension fund managers, those type of guys. Corporate client buybacks accelerated to their highest level since late June. Year to date, buybacks as a percentage of S&P 500 market cap are still on pace for a record year in our data's history. That's very interesting because buybacks as a percentage of S&P 500 market cap in 2021 was huge. So, and companies are making money and they're showing investors the money. And especially when the data looks like this is absolutely crazy. MSCI AC World EPS. Guys, look at 2023 EPS, 2024, 2025. We're actually expecting huge growth in the all country world index. So we're actually looking at 13% growth next year in 2025. And while I do think that these estimates do have to pull back, I've been saying that for a couple of weeks, I still think we're going to get double-digit growth figures here in 2025. And we're also set to see margins expand in 2025. Currently, net margins sitting at 11.4%. 2025 see 12.2%. Very, very interesting. We have a couple of other geographies we can look at here. S&P 500 earnings set to grow at 15%. The stock 600, so the S&P 500 of Europe, at 10.5%. Margins expanding in each. Japan is looking at growing earnings 9.6% in 2025. Margins expanding too. MSCI excluding Japan actually growing double digits. Margins expanding it too. And then emerging markets with the highest growth, they see 2024, 2025 growth 23.5%, 16.1%, and margins going from 10.9 to 11.7% respectively. Very, very robust earnings. You can't just say, hey, this is the US market holding everything up, because we're seeing double-digit growth in every single geography except Japan on an FX neutral basis. And you want to hold equities, guys, when earnings are growing and margins are expanding. That is when equities tend to outperform the average year, but they tend to underperform the average year in bear markets. And that's the question we have to ask ourselves, because we've been in a bull market for quite some time, and now the question is, when does that end? And I have some very interesting data about bull markets right here. Now, the average duration of a bull market not following a former recession is 33 months. That would take the S&P 500 to May of 2025. The average bull market gain when not preceded by a recession is 63.6%, which would take the S&P 500 to 58.52. But notice something else, guys. If the bull market ended in July, it would be the shortest market in history, tied with that from 2020 to 2022. Now answer this question for me. Do you think the market would suffer the shortest bull market in history in back-to-back occurrences? This data right here informs us that is very likely not the case, and you do have to take into consideration we are going into a cutting cycle. Here in 2021, we moved into a hiking cycle. So is the bull market far from over? I think so. I think we're gonna continue this bull market into 2025-26 as long as earnings and margins stay the course and the economy stays the course. And right now the market is trying to figure out, are we going to get a 25 basis point cut or a 50 basis point cut? After the data PPI, CPI, everything is looking towards the 25 region, and that's actually a good thing. This is the first Fed rate cut after a hiking cycle. We have 1, 2, 3, 4, 5 different instances, so not a statistically significant set of data, but the data pool is largely small because hiking cycles and cutting cycles are far and few between. And you can see here that in the S&P 500, when the first move was a 25 basis point cut, okay, 1 year, 2 year, 3 years later, in every single one of these instances, the market did very, very well. You can see here in 2019, we cut by 25 basis points as the first move. 1 year later, 13%, 54% 2 years later, 46% 3 years later, 65% 4 years later, 101% 5 years later. The same is true in 1998 and 1995. However, when the first cut was 50 basis points, the returns were not that great 1, 2, 3, and 4 years later. And that's because there was real trouble under the hood. And that's why we needed to cut by 50 basis points. So the Fed cutting 25 basis points next week is actually going to signal to the market that, hey, things are not deteriorating. The economy is largely robust and we're cutting to normalize policy versus to avoid a recession. Whereas a 50 basis point cut probably means they have access to data that's not that great under the hood. We don't want a 50 basis point cut. We want a 25 basis point cut to start. History tells us that returns after a 25 basis point cut tend to do very, very well. Now, where do you want to be positioned when the Fed cuts rates? Large caps, mid caps, or small caps? This is very interesting. The mid caps, after the first Fed rate cut, tend to outperform 12 months later, up 13%. The S&P 500, about 10%. The Russell is the worst performer, up about 5%. And we see the same dynamics 3 months later. So according to this data, you want to be in mid caps, you want to be in large caps. I don't think you want to avoid small caps. I think being in something like small cap quality, that's where you want to be. Now, looking at the S&P 500, when we've had a Fed cut and the market has actually seen expansion in years such as 98, 95, 89, 87, 71, and where we are right now, the average return 12 months later, 16.5%, the win ratio 100%. And we see very robust returns 1 month, 3 months, 6 months, 12 months later, outsized returns relative to the median S&P 500 return of about 9.8%. So guys, all of this data is telling us that we want to be long equities, sit through the volatility, and we want to buy dips. Now guys, I thought we actually take a macro view of the economy, broad spectrum view, look at the major indicators and just see where we stand leading up into next week's rate cuts. Because we are going into a cutting cycle, it's very likely we're going to get 25 basis points worth of cuts. And right now, the unemployment rate saw a decline in August, which points to positive signs for the economy. It could indicate a strengthening job market and potential growth opportunities ahead, especially with the weaker than expected jobs numbers we got. This number actually declining is really a good thing, and we'll see how this pans out for the rest of the year. Looking at the establishment survey and the household survey, the latest data shows a decline in the unemployment rate for August. These both look very healthy, signaling encouraging signs for the economy. It suggests, again, a healthier job market and potentially an increase in employment in the near future. Wage growth actually accelerated to 3.8% right here, and wage growth is a little bit sticky, well above the pre-pandemic levels. Daily data for debit card transactions show that consumer spending has actually accelerated here in recent weeks, driven by spending on clothing, food services, drinking places, sporting goods, as well as motor vehicle and motor vehicle parts. We also saw weekly retail sales data increase in the last week. The Redbook index remained very strong. The steady performance points to continued momentum in the retail sector. Jobless claims have been on a steady decline for several weeks now. This trend reflects growing stability and the potential for a recovery in employment in the future. And continuing claims have been on a steady decline for several weeks as well, indicating sustained improvement in the labor market. The trend suggests that more people are returning to work and that job recovery is actually gaining momentum. Default rates and weekly bankruptcy filings are trending downward, signaling improved financial stability for businesses and consumers. The decline points to a healthier economic environment and reduced financial stress in the market. These are very, very low levels right here. The Fed's weekly GDP now is sitting at 2.5%. S&P 500 forward profit margins are at all-time highs. And guys, when margins are expanding and earnings are increasing, stocks generally do very well in that type of environment. And stock prices for staffing firms like ADP and Paycom Software are rebounding, which suggests a potential increase in job openings ahead. The bottom line with all of this, guys, is that the US economy is not in a recession and there's no clear signs of one on the horizon. Economic indicators continue to show stability and growth, and you don't have to buy into the media fear. You simply have to look at these indicators in aggregate as I've simply shown them to you right now. So data in the week ahead. So we got PPI this week, and then tomorrow in data, we don't have much of anything, guys. We just have import prices and then the consumer sentiment index. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, and like this video, guys, and also leave a comment for the algorithm. Cheers.